Owning a car gives you the freedom to travel wherever and whenever you want. But the question of whether to buy, lease, or finance one can leave you second-guessing your options. It's a decision that could have a lasting impact on your financial health. Each choice comes with its own advantages and disadvantages, and selecting the right one for your lifestyle and budget is crucial. Let's explore 5 smart ways to decide whether buying, leasing, or financing is the right move for you. By the end of this video, you'll have all the tools you need to make an informed decision, save money, and avoid common financial pitfalls. Stay tuned, because the 5th option is one you won't want to miss, especially if you're looking to maximize value while keeping your monthly costs in check. Option 1. Buying a car outright. The pros and cons. When you buy a car outright, you make a single lump sum payment, and from day one the car is yours. No loans, no monthly payments, just the car. It might seem like the perfect option if you have the funds, but is it really? Here are some pros of this option. No ongoing payments. Once the car is yours, it's yours. There's no need to worry about interest rates or monthly installments. Full ownership. You have complete control over the car. Want to drive it for 10 years? Go ahead. Need to customize it? Feel free. Avoid interest fees. When you pay up front, you avoid the hefty interest rates that come with financing. Here are some cons of this option: opportunity cost. Tying up a large amount of cash in a car might not be the best use of your money. Could you invest that money elsewhere and get a better return? Depreciation. As soon as you drive off the lot, the car loses value, which can feel like money slipping away. Maintenance. Owning a car long-term means you're responsible for all repairs and upkeep, especially as the car ages. If you're someone who keeps cars for a long time and doesn't want the hassle of monthly payments, buying outright might be the way to go. However, consider whether locking up a large sum of money in a depreciating asset makes financial sense for your situation. Option 2. Financing a car. The balance of ownership and flexibility. Financing a car is the middle ground between buying outright and leasing. Here, you pay a deposit and borrow the rest, repaying it over time with interest. At the end of the term, you own the car, but it comes with more ongoing costs. Here are some pros of this option. Own the car eventually. Once your payments are done, the car is yours to keep. Lower upfront cost. You don't need to pay the full price up front, making it more accessible if you don't have a large sum of cash on hand. Predictable payments. With fixed monthly payments, you can budget easily for the cost of the car. Here are some cons of this option: interest costs. The total cost of the car will be higher because of the interest on your loan, which can be significant depending on your interest rate. Depreciation risk. You're still responsible for the car's depreciation, and by the time you own it, it may be worth much less than you paid. Long-term commitment financing ties you into a multi-year contract, meaning you're stuck with the car for a while unless you want to sell it, which could be at a loss. Financing a car works best for people who want ownership but need flexibility in their payments. Just be sure to shop around for the best interest rates to minimize the total cost. Option 3. Leasing. Drive new. Pay less monthly. Leasing a car is like renting it. You make monthly payments, typically lower than if you were financing, and at the end of the lease term, you return the car. You don't own the car, but you get to drive a new one every few years. Here are some pros of this option. Lower monthly payments. Lease payments are generally lower than finance payments since you're only paying for the car's depreciation over the lease term. Drive new cars more often. Leasing allows you to upgrade to a newer model every few years, so you always have a car with the latest features. Minimal maintenance costs. New cars require fewer repairs, and most leased vehicles are under warranty for the duration of the lease. Here are some cons of this option. No ownership. At the end of the lease, you return the car and have nothing to show for it. No asset, no equity. Mileage restrictions. Leases often come with mileage limits, and going over can result in hefty penalties. End of lease fees. You're responsible for any wear and tear on the vehicle, and fees for excess wear can add up when you return it. Leasing makes sense for people who prioritize lower monthly payments and like having a new car every few years. However, if ownership is important to you, leasing may not be the best option. Option 4. PCP. Personal Contract Purchase. The hybrid approach. Personal Contract Purchase, PCP, combines elements of both leasing and financing. You pay a deposit and make monthly payments, but at the end of the term, you have a choice. Return the car, pay a lump sum to buy it, or trade it in for a new one. Here are some pros of this option. Flexibility. At the end of the contract, you can choose whether to keep the car, return it, or trade it in. Lower monthly payments. Like leasing, PCP payments tend to be lower than traditional financing because you're not paying for the entire car's value. Newer cars. Similar to leasing, you get to drive newer cars with fewer maintenance issues. Here are some cons of this option. Interest rates. Just like financing, PCP comes with interest, making the overall cost higher if you choose to buy the car at the end. Final lump sum. If you want to keep the car, you'll need to pay a large final payment, the balloon payment, which can be a significant financial burden. Mileage restrictions. Like leasing, PCP contracts often have mileage limits, and exceeding them can result in penalties. PCP works best for those who want flexibility at the end of their term. However, be sure to calculate whether the final lump sum is worth it before committing to this option. Bonus tip: consider a nearly new or certified pre-owned car. Here's the tip that car dealerships rarely tell you about. Buying a nearly new or certified pre-owned car can often be the best of both worlds. These cars are typically 1 to 2 years old, which means someone else has already taken the hit on depreciation, but the car still feels nearly new. Here are some pros of this option. Lower cost. These cars are significantly cheaper than brand new ones, but still come with modern features and warranties. Avoid new car depreciation. New cars lose their value quickly, but with a pre-owned car, most of that depreciation has already happened. More bang for your buck. You can often afford a nicer model for the same price as a new lower-tier car. Here are some cons of this option. Limited selection. You may not get to choose every feature or color you want, as your options are limited to what's available. Potential for more wear. Although certified pre-owned cars come with warranties, they may have more wear and tear than a new car. If you want to avoid the major cost of depreciation while still getting a relatively new car, going for a certified pre-owned model might be your smartest financial move. At the end of the day, whether you decide to buy outright, finance, lease, or go for PCP, the key is to run the numbers for your own situation. Look at the total cost, not just the monthly payments, and consider factors like your driving habits, how long you plan to keep the car, and your overall financial goals. If you found value in this video, make sure to subscribe to Finance Geekx and leave a comment below on how you plan to purchase your next car. And don't forget to click the notification bell so you don't miss our next video on savvy money-saving tips. See you there.